Hey guys, welcome back week two. So we're going to be going over chapters 3 and 4 today. It's value in bonds and stocks. And so chapter 3 starts dealing with value in bonds. So when we talk about a bond, this could be a corporate bond. It could be a government bond. But a bond is a debt instrument issued by a company or a government that pays a fixed interest rate called a coupon rate over time, and it repays the original principal face value at maturity. So the issuer is the borrower, the corporation or the government, and the investor is the lender, the bondholder. So you loan money to a government or a corporation. So, like in this case of a corporation, if you buy stock, you're an owner. But if you buy a bond, you have still, both ways, the company has gotten money. You have voting rights with stock if it's common stock. But with a, a bond, you don't. With a stock, it goes up in value. With a bond, you just get paid back an interest rate. And that's how you make money. So that's the difference between like a stock or a bond. Um, but the coupon is the periodic interest payment that's made to the bondholder. It's usually annual or semi-annual. It's based on the bond's face value, say typically about $1,000. So if it's a 10-year bond with a 6% annual coupon, that pays $60 a year. So it's not 6% every month; it's 6% over a whole year. And so if you're looking at the monthly rate, you would have 6% times the number of months divided by 12. So if it's 3 months out of the year that you're earning it, or 90-day bond, then it would be, uh, the full $60 times 3 divided by 12. So when we're talking about like a face value or par value, this is the amount the bondholder would receive when the bond matures. So whatever you bought that bond for, say it's $10,000, you get that back when it matures, plus you picked up all the interest along the way. So maturity would be the time at which the issuer repays the bond's face value and stops making interest payments. So, for example, a 5-year bond that matures in 5 years, and after that, the bond ceases to exist. Yield to maturity would be the rate of return an investor will earn if the bond is held to maturity. So, yield to maturity would equal the present value of the bond's payments and compare it to the current market price. So think of that like an internal rate of return for the bond itself. We're talking about present value of bonds. So the bond's value is the sum of the present values of its future coupon payments and the present value of its face value. So $1,000 bond paying $50 a year for 3 years with a 5% market rate. So you would calculate that value, the price of it would be 50 divided by 1.05 because it's a 5% rate to the first power. That's year one. Then you'd add 50 divided by 1.05 to the second power. That's year two. And then it would be 1,050 because you pay back the whole 1,000 plus the $50 in year three over 1.05 to the third power. You add all that together, and that's the price of the bond. That's what it would be worth. And so there's so the face value of the bond, if the price is less than the face value of the bond, then the yield to maturity will be greater than the coupon rate. And when the price is greater than the face value, then the yield to maturity will be less than the coupon rate. And really, it's because the market interest, when the market rates rise, the older fixed rate bonds will become less attractive. So that's where you're buying things at a premium or discount. Uh, the bond rating, the credit worthiness grade assigned by agencies are like Moody's or S&P. So a AAA would be the highest quality, and the junk would be the high risk. Um, but it is important that you honor, as an organization or a government or anything else, that you pay back these bonds. And a lot of times people like to invest in them because they are a safe bet. Bonds really reflect sort of a moral agreement. Um, and in the Bible, honoring those promises is really non-negotiable. You are to, in Romans 13, it talks about paying to all. That is what's owed to them. So it is important as a Christian that you honor those commitments. Uh, so chapter 4, valuing stock. So what is a stock? So stock is basically a share of ownership in a corporation. So unlike a bond, you've given money to you bought some shares. You actually own the company. In a bond, you have just owned uh, you've signed an agreement where they're going to pay you back what you have borrowed. Um, but a stock is a share of ownership in a corporation, and shareholders are partial owners that are entitled to future profits. And there's two main types of stock. There's common stock, and that's the one most time people buy. It has voting rights and potential dividends. Preferred stock has fixed dividends, so you're going to get paid your dividends first with a preferred stock over the common stock. And that's really why people prefer it, but you don't have voting rights. So that's really the big difference there. When we talk stock valuation overview, unlike bonds, which have fixed payments, stock values depend more on dividends, if there are any growth expectations, any risk, and required return. Uh, then the value of the stock is going to equal the present value of all of your future dividends. So whatever those future dividends are, you present value them back today, and then that'll give you the value of your stock. Um, there's a couple models out there that you'll get to where there's the dividend discount model, and this method is basically for valuing stocks based on the present value of expected dividends. And so, for example, if a stock pays $2 next year and it grows at 4% and the required return is 10%, then you would end up uh, calculating the stock price today would be about $33. And so you would put the $2 over the in the numerator over the 10% required rate of return minus the 4% growth rate, and that would give you a 33.33 price today. There's also the no growth model when dividends are flat and they're not offered, so they don't grow. The example would be like a $3 dividend that is required at 6%, and so that would just be the $3 dividend divided by 0.06, and that would be a $50 price point, stock price today. There's non-constant growth stocks. So for early high-growth firms like tech startups, sometimes they use a multiple stage DDM model, and the forecast specific dividends year by year before transitioning to constant growth. There's the price to earnings ratio. And the definition here, the price to earnings equals the stock price divided by the earnings per share. It indicates how much investors are willing to pay per $1 of earnings. So a high P&E, investors expect growth, and a low P&E could be undervalued or risky. So if a company earns $5 a share and trades at $75, the price earnings ratio will be 15. The valuation by comparables. Here, if you're estimating a firm's value by comparing it to similar companies like peer analysis, you want to use metrics like price earnings, price of sales, or EBITDA, EBITDA, earnings before interest, taxes, and depreciation. Um, so this is good for companies with no dividends or unpredictable growth. For example, if a competitor earns or trades at 10 times the earnings and your firm earns $3 a share, the estimated value would be about $30 a share. Um, so really the big thing is when we're talking about like a lot of valuing, it's important to get a fair valuation of what the company is. And so we don't want to manipulate the stock price, especially as Christian leaders. We need to make sure that our valuations are honest and ethical and avoid hype. A lot of that comes into the way that we value things in accounting and the principle of conservatism, the accounting principle of conservatism, where we understate or hold back. We don't overstate our earnings. We are more conservative with our estimates, and so it's sort of like under promising and over delivering a little bit. Uh, but in Proverbs it says that the Lord detests dishonest scales, but accurate weights will find favor with him. So that's really what chapter 2 is going to entail. You guys, I wanted to leave you with that. If you have any questions or need anything from me, let me know. Uh, I'm always here to help. Talk to you guys soon.